Hi everyone, myself Prezi. Welcome to my channel Commerce Class. This video is about liquidity ratio. Before moving to that topic, I will give you a brief explanation on the topic ratio analysis and importance of ratio analysis. Ratio analysis is one of the most powerful tool of financial analysis. This shows the quantitative relationship between figures and group of figures. And this technique is very useful for analyzing and interpreting financial statement and also taking various business or financial decisions. So ratio is an expression of quantitative relationship between two numbers, and financial ratios the relationship between two accounting figures expressed mathematically. This technique is used for understanding financial strength and weakness of firm. In this technique, usually firms select relevant data from financial statements, and data collection is based on the objective of analysis. Then after collecting information, firm want to calculate appropriate ratios. Then compare this calculated ratios with ratios of same firm in the past. Then after comparison, next step is interpretation of these ratios and take financial decision based on these interpretations. Liquidity ratio. What is liquidity? Ability of a concern to meet its current obligation is known as liquidity. How can a firm meet its current obligation? A firm can meet its current obligation by realizing amount from current asset. So current assets are those assets which are easily converted into cash within short period of time. Inventory, cash in hand, cash at bank, sundry debtors, marketable security, etc. are current asset. The sufficiency and insufficiency of these current assets should be assessed by comparing them with short-term liabilities or current liabilities. If current asset can pay off current liability, then we can say that liquidity or liquidity position of that firm is satisfactory. Otherwise, liquidity position is not good. Banks, suppliers and creditors, short-term creditors usually analyzes the liquidity position of the concern, and they extend credit only if the current assets are enough to pay off the current liability. So, the liquidity ratio measures liquidity of the concern. So, liquidity means ability of a firm to meet current obligation using current liability. So, different liquidity ratios are current ratio, CUKE ratio, absolute liquid ratio. Current ratio. Current ratio is the relationship between current asset and current liabilities. Current ratio is also known as working capital ratio. Current ratio measures general liquidity and it analyzes the short-term financial position of the firm. Formula for calculating current ratio is current asset divided by current liability. Current assets are those assets which are easily converted into cash within short period of time. Then current liabilities are obligations which are payable within short period of time, generally 1 year. Then components of current ratio. Current asset and current liabilities are the components of current ratio. Current assets are cash in hand, cash at bank, marketable securities, bills receivable, sundry debtors, inventories, prepaid expenses, etc. Current liabilities are outstanding expense, bills payable, sundry creditors, short-term advances, income tax payables, dividend payables, bank overdraft, etc. Then ideal current ratio is 2:1. That means current assets are 2 times of current liability. A high ratio is good to the firm. A high ratio indicates that firm is liquid and firm has the ability to pay its current obligation. But a very high ratio is not good to the firm. This very high ratio is due to certain reasons like slow moving stock, then high sundry debtors, then idle cash and bank balance. Slow moving asset or slow moving stock indicates poor sales. Working capital is blocked in inventories. So the firm must take necessary steps to overcome this situation, and proper inventory management should be used by the firm to control this situation. High sundry debtor indicates that debt collection is not satisfactory and revenue is not realized from credit sales. Proper receivable management tools should be used by the firm to control this situation. Then idle bank or cash balance. Idle cash and bank balance has opportunity cost, and firm must invest these cash in some productive investments. So for that, proper cash management tools can be used by the firm. So usually firm uses 2:1 as the ideal ratio for analyzing the short-term financial position of the firm. Second one, CUKE ratio. CUKE ratio, also known as acid test or liquid ratio. CUKE ratio shows the relationship between CUKE asset and current liabilities. CUKE assets are also known as liquid assets. Liquid assets means assets which are easily converted into cash within short period without loss of value. Here, cash in hand, cash at bank are the most liquid assets. The other liquid assets are bills receivable, sundry debtors, marketable securities, and short-term investments. Inventories and prepaid expenses are not treated as liquid assets because these are not converted into cash immediately without sufficient loss of value. Ideal CUKE ratio is 1:1. That means liquid asset is equal to current liability. Absolute liquid ratio. Absolute liquid ratio is also known as cash ratio, and this shows the relationship between absolute liquid asset and current liabilities. Cash, bank, and short-term securities are absolute liquid assets. So here these three items, cash, bank, and short-term securities, are more liquid than any other current liabilities. Here ideal ratio is 50% or 0.5, and formula for calculating absolute liquid ratio is absolute liquid asset divided by current liability, or cash plus bank plus short-term securities divided by current liabilities. That's about liquidity ratios. In this video, we discussed about liquidity, different types of liquidity ratios. Hope you all understood this topic. If you are not yet subscribed my channel, please subscribe and share my videos. Thanks for watching my channel. Bye.